Hi, welcome to Cal CPA's tax series. My name is Michael Stein. I'm with the firm Hochman, Salkin, Toscher, and Perez in Beverly Hills, California. My practice area is tax controversy and litigation. Today, we'll be covering tax cuts for small businesses and individuals. Today, we'll walk you through the key provisions of the One Big Beautiful Bill Act relating to small businesses and individuals. We'll focus on five main areas: the extensions for the tax rates and standard deduction, the child care credits, qualified business income deduction, the new above the line deductions, which are exciting, and then some other repeals of exemptions and the inclusion of a new senior deduction. Section 70, 101, and 102 is the meat of the act. And what it does is it extends the 2017 Tax Cuts and Jobs Act's rates that were set to expire after 2025. And it makes permanent the 7 income tax brackets that existed under that act. Otherwise, rates would have increased. It also continued the enhanced standard deduction, which is a major simplification for taxpayers. It makes that adjusted annually for inflation, and it's $15,750 for single people and will continue to be $31,500 for married people. That's very important because it does simplify the taxes, because most people will no longer itemize, but will fall and continue to fall under that standard deduction rate. Child tax credits on slide 5 came in under section 7104. It continues to support families with qualifying children. It's very important because it reduces tax liability per qualifying child. It encourages workforce participation by offsetting child-related costs, and it increases the credit to $2,200 per qualifying child. It extends the phase-outs that existed at $200,000 for singles and $400,000 for married. It also extends the identification requirement. Each person and child must have a Social Security number, which makes it that information needs to be included on the return. Let's talk about the qualified business income deduction. We refer to section 70-105. There is now the 20% QBI deduction was made permanent. Initially was set to expire after 2025. It benefits pass-through entities such as LLCs and sole proprietorships. It expanded the phase-in thresholds. It went from 50 to 75,000 for single filers, and I think 100,000 to 150 for joint filers. It also ensured a floor, a minimum QBI for lower income taxpayers with at least $1,000 in qualified business income. I think the next slide is the most important. It talks about the new above the line deductions. It's a newest addition to the act. These did not previously exist. Some would say the part of the act that most people are excited about who qualify. These provisions support workers and middle income earners. It's available regardless whether you itemize or not, which is, very, very helpful, which means that these deductions are above the line deductions. It lowers adjusted gross income, making other credits and benefits easier to access. It's a positive all around. The new deduction includes 3 types: for tips, overtime, and auto loan interest. Let's go in order. For qualified tips, that's up to $25,000. There's a temporary tax deduction for 25, 26, and 27 for qualified earners. Eligible only for those occupations that customarily receive tips before the end of 2024. So for example, if you're in an industry such as restaurants or valets or other industry deliveries where tips are customarily given, you could be eligible. If you're a law firm or an accountant or some other service provider that doesn't work on tips, probably not eligible. The phase outs are pretty generous. For the qualified tips, it begins at 150,000 for single people and 300,000 for joint, with $100 reduction per $1,000 over the threshold, which means that, if you're married, it starts phasing out at 300,000. And then if you earn an extra 100,000 on top of that, the qualified tip amount only gets reduced by $10,000. That's pretty generous. So it's going to affect a lot of people who are in that range, and a lot, people who are in less than that too. And then overtime pay provides a deduction of up to $12,500 for single filers or $25,000 for joint filers who receive qualified overtime compensation. Seems like a good thing. It's defined as amounts earned above the regular rate under the Fair Labor Standards Act. So for example, if you work more than 8 hours a day in California or more than 40 hours a week in California, that additional amount of money might be considered qualified overtime compensation. It has similar phase outs, 150,000 for single, 300,000 for married. And that reduction is pretty generous too, as we talked about. So we expect a lot of people will benefit in the tip industry for qualified tips deduction. And remember, it's a above the line deduction. So even if you don't itemize, you get this deduction offsets the income. And the overtime for overtime, I think will affect a lot of people too. Let's talk about the auto loan interest. It's up to $10,000 of interest of an above the line deduction for years 2025, 26, 27, and through 2028 of up to $10,000 annually for interest paid on loans used to purchase a new, only U.S. assembled passenger vehicle for personal use. Okay, let's repeat that. It has to be assembled passenger vehicle in the U.S., annual interest up to $10,000. It has some phase outs, $100,000 for single, $200,000 for joint. And the vehicle must first be used by a taxpayer, has to be under 14,000 pounds and assembled in the US. But if you think about this, that's a lot of interest a year for an auto loan. And because it has some limited phase outs of 100 to 200,000, we don't necessarily think that too many people will fall in that. And I'll give you an example. Even if you purchased a $30,000 car and it's a 10% loan, well, maybe you'll get a $3,000 deduction, and that's not up to, it's up to 10,000. So that's pretty helpful. But it's, it's a limited amount of people that are really going to get up to the 10,000 amount, because that's a lot of interest. That's, 10% on a $100,000 loan. So I think it helps, but it may not be as helpful as the overtime pay or the qualified tip pay deductions. This portion of the Act, 7103, actually eliminates continues to eliminate their personal exemption that once existed. That personal exemption was previously at $4,000 per person. And those are permanently repealed, gone. So I think Congress figures that you're going to make up deductions in other categories. So it eliminated this per person. However, if you're a senior, which is age 65 and over, you can now deduct up to $6,000 for a senior for beginning with 2025. So although the personal exemption went away, for seniors, there's now a larger exemption, potentially up to $6,000, which also reflects a shift towards simplified filings and fewer line item deductions. So the next slide is just a summary of what we talked about under the above the line deductions. And in looking at it on the left-hand side, you see the qualified tips, the overtime, the car loans. You see what the limitations are. You see what the phase outs are, as I just note on the bottom for car loan interest. It's 100,000, or I think I said 200,000. And then it completely ends at 150 and 250. And those are the years. It's 2025 to 2028 for each of those deductions. Just sort of concluding, these provisions aim to extend relief from the Tax Cut and Jobs Act, which were set to expire. They support working families and small businesses. They simplify tax filings. So some of the questions to consider is, how will these affect your own tax planning or that of your clients? Do you need to start thinking about shifting income out of the year or into the year so you can qualify for some of these interesting deductions? And maybe if you're someone who received tips or overtime, you might want to adjust your W-4 to account accordingly. And I do believe that even though tips or overtime will not be subject to income tax, it still would be subject to employment tax. So there still will be deductions for that. And then another thing to consider is what benefits apply most to your practice or to your situation. And there you have it. Stay tuned for more episodes. Take care.